Good morning, everyone. My name is Joe Bloodgood. I'm a partner here with Boulay Financial Advisors. On behalf of our entire team, I want to welcome everyone to our Global Market Outlook conversation with Jeffrey Kleintop. We look forward to having a great conversation, a robust conversation this morning with all of you. So just a couple pieces of housekeeping before we get started. Jeff has about 30 minutes of prepared comments for us this morning, but we are going to have time for Q&A at the end, and I would encourage you to use the Q&A icon on Zoom. Feel free to put in a question and we'll attempt to answer as many of those as we possibly can. I would also let you know that you would be asking the question anonymously, so feel free to sort of pour your heart out there if that's helpful. A little bit of background about Jeff, and then we'll turn it over to him and we can get started. Jeff is the Chief Global Investment Strategist at Charles Schwab Co. Charles Schwab is a great partner to Boulay. They serve as a custodian for many of our clients. He's responsible for identifying, evaluating, and commenting on significant risks and opportunities in the world's capital markets. If you look sort of under the hood in our industry, he's sort of on all the best of the best lists that the different publications have out there. He's also the author of the popular investment book, Market Evolution: How to Profit in Today's Changing Financial Markets. I think you'll all enjoy Jeff's comments this morning. Today's the last day of November here in 2022, and it's been a bit of a wild ride in terms of the markets. So I know Jeff is prepared to talk about really all things markets as it relates to recession or bear markets, what's going on with interest rates, what kind of geopolitical risks are we facing, and much, much more. So without further ado, I'll turn it over to Jeff. Welcome, Jeff.
Thank you, Joe. Thanks, everybody, for tuning into this. And I'm going to try and make this worth your while. Look, there's so much that happened this year. I'll recap a little bit of how we got here and where we are, and then really talk about what are we looking at next year, 2023? How does that shape up? What are we looking at from a standpoint of recession and bear market? Where are we in all of that? What does this mean for the inflation picture? Is inflation finally cooling? And if so, what does that mean for central banks? It's really been rate hikes by the Fed and other central banks around the world that have driven much of what we've seen in both in the stock and the bond market this year. So what does that look like over the next few months and over the course of the year? And then talk a little bit about what are some of the surprises for next year as we look out to next year. You know, this year was defined by a number of things, including Russia's invasion of Ukraine. So what are similar type of events that may affect next year in a material way? And then what are some of the investment ideas? What are some of the things that we can look forward to? Maybe parts of the market that are more rewarding. I think a diversified portfolio really pay off next year as we see outperformance in a number of areas where we haven't seen performance in some time. So let me get started. Oh, and by the way, I want to reiterate what Joe said about the questions. There's no way I can cover everything that's on your mind. There's so much going on right now. It's a bull market of things to talk about. So please get those questions in. I've got about 30 minutes of prepared comments, and I want to get to what's most important to all of you. So where are we on this recession watch? There's certainly some folks have said, well, we're in a recession already. We were in the first half of the year since we saw 2 quarters of back-to-back negative GDP in the U.S. And yet we just got the second revision to GDP for the 3rd quarter, and that was positive, 2.9%. So are we in a recession? Are we not in a recession? What about the rest of the world? Where do we stand on all of this? Well, one of the things I like to look at as an indicator of recession is the yield curve. You may have heard about it. It gets a lot of attention. And often strategists like myself or economists will refer to the difference between 2-year and 10-year government bond yields. And they'll say, well, when the 2-year yield rises above the 10-year yield, when short-term rates are above long-term rates, it's a sign of recession. But some will focus on the 3-month to 10-year, or Chairman Powell at the Fed is really focused on the 3-month to 18-month different yields of Treasury securities. Look, I set all that aside. There are 91 different ways we can look at short versus long maturities of government bonds. And generally, when the shorter ones are shorter maturity bonds have a higher yield than longer term bonds, which is very rare, right? Usually a 3-month CD has a lower rate than a 30-year mortgage. But sometimes that's not the case. Usually when inflation's rising, the Fed is hiking interest rates, and when long-term investment prospects have started to weaken, we get what we call an inverted yield curve. Now, rather than look at any one of these particular relationships between, let's say, 2 or 10 year or 3 month and 10 year, I look at all of them, 91 of them. And the percent of those that are inverted are what's on your screen right now. That blue line is the percentage of all of those 91 different maturities of the yield curve and how many of them are inverted, meaning how much of the yield curve is inverted. And right now it's over 80%. And what you can see is whenever we get a spike like this, we get a gray column. Those gray columns are recessions, periods that were determined by the National Bureau of Economic Research to be periods of declining economic activity, where output shrank. We just didn't make as much stuff, where jobs fell, where earnings fell, where stocks fell, anywhere from 20 to 50%. These are bad times. We want to know when they're coming and do our best to get through them unscathed. You can see this is a flawless track record of predicting recessions. Whenever this gets over 50%, it's never failed that we're in a recession. We're over 80 now. This hasn't yet been officially declared a recession. Yes, we've had 2 quarters of back-to-back GDP, but in the US, and only in the US, is that not determined a recession. We use the National Bureau of Economic Research, which looks back, usually only after a recession's ended, and they determine the start and the end date, and then let us know what those were. So in real time, when we're going through it, we generally don't have the official verdict that we're in one, but I think it's pretty safe to say we're already in a recession. And when it began, when it ended, well, we'll have to see. I think we're probably more than halfway through it. But globally, I can tell you that I think it only began recently, somewhere in the 3rd quarter. Most of the world actually grew pretty well in the first half of the year, in part because economic activity was still being boosted by reopening from COVID in Europe and in Asia. But that really slowed in the 3rd quarter. Let me show you what I mean. Here's some data rather than just the yield curve as an indicator. The yield curve doesn't cause the recession. It indicates it. This is some evidence in the data causing the recession. This is one of my favorite indicators. It's actual data. This is from the OECD. You may have heard of them, the Organization for Economic Cooperation and Development. It's a big economic think tank. They've been plotting economic activity for 50 plus years, and this is their leading economic indicator for the world, for 40 plus countries, accounting for more than 90% of GDP. And whenever this indicator drops below 99, I drew that line across there, that orange line. Whenever it drops below 99, we get, you guessed it, a gray shaded column, which is, as you know, a recession. A couple of times we had a double dip in the early 90s. You'll see we dropped below 90, 99, and then we rebounded, but then we fell back down again before recovering. Same thing happened in the early 2000s. But generally, when we drop back down that below that line, we get a recession. I think this is a clear sign we're probably in one now among most of the major economies in the world, throughout Asia, Europe, and of course, North America. Here's another one, and I'll just leave you with this. I could show you many others, but this is the Global Purchasing Managers Index. We call it the PMI. It is my favorite economic statistic. It is my desert island number. I'm on a desert island. I can only have one economic statistic, and what else would you want on a desert island but an economic data? It's the Purchasing Managers Index. This is a survey of business leaders at, in this case, manufacturing firms. And what are they seeing? What are they seeing in terms of orders, inventory, pricing, customer demand, output, production? It's all scored together. And whenever this is below 50, that's the dividing line between recession and expansion on this indicator. Whenever it drops below 50, manufacturing enters a recession. And I could take it back a lot further, but this is the global one. And going back further, you have a limited number of countries, the US and a few other big countries, but just globally, 40 big countries going back to the late 90s. You can see whenever we drop below 50, we tend to get a recession. Sometimes we have a glancing blow, but I think we're there. And so manufacturing is now in a slowdown. Partly because inventories are really high, right? A lot of product was ordered a year ago when we were dealing with the supply shortages. That all showed up in the first half of the year, just as consumers were beginning to slow their purchases. Businesses in manufacturing and retailers are now overburdened with excess inventory. and they're trying to clear it as fast as they can. Really aggressive discounts, trying to push the products out the door, total opposite of a year ago. And we're seeing things fall like used car prices, furniture, apparel prices plunging in each of the recent inflation reports as they try and move these things out the door. But another consequence is there's less demand, so less production, because they've got to wait till they clear all this stuff out from inventory before they order new goods. So we're seeing orders come down and shipments come down, and that means manufacturing has entered a recession globally. So a lot of these indicators point to the fact that we're probably already in one, probably entered it at least sometime in the third quarter, could have been earlier than that. But stock market figured this out quite a while ago, right? Stocks peaked on January 3rd of this year, recognizing that with the Fed hiking interest rates, the inventory burden, and by the way, a year ago in November, I published an outlook for this year called From Shortages to Gluts, expecting we'd see this inventory burden and a slowdown in production begin to accumulate here in 2022. And indeed we did. No one was talking about it back then. It's certainly the theme of the year, excess inventories. And so the consequence of all this is that stocks have figured it out. And no surprise, stocks are in a bear market, but so are bonds. And so is cash on an inflation adjusted basis anyway. Big rise in interest rates this year means one of the biggest down years for the bond market in decades. Stocks, as we know, whenever they drop 20% or more, we call it a bear market. And they did. They've recovered a little bit. Just looking here, year to date, the S&P 500 is down 17%. Recovered a bit, but still entered a bear market this year. And then cash, we know cash yields just aren't keeping up with inflation. But I could apply this to gold, commodities, crypto, Bitcoin. Everything's been in a bear market this year. Very rare to see a year when all these major asset classes are in a bear market together. It's only happened a couple of times in the last 50 years. Those were in the 1970s, lasted about 9, 10, 11, 12 months. And then it was over and we started to see a recovery. Hopefully we'll begin to see that unfold here in the months ahead as we start to see some of the conditions begin to shift. But this is really important. So many investors are focused on, well, we're in a recession, we're in a bear market. When is it going to end? I get this question all the time, going on CNBC, Bloomberg, in front of audiences. Okay, when's it going to end? I don't know what they would do. The month, the week, the day, the hour? I don't know, right? I mean, I can give you a sense that I think we're nearer the end of it than the beginning. We could retest the lows in the stock market, certainly as earnings come down a little bit here. But I think we're forming a bottom in the markets. But I think that's missing the point. Obsessing over when does the market bottom misses the point that already we've seen an important change in leadership in the markets. I think is durable, is sustainable, not just over the next few months, but over the next several years. And if you miss this, you're going to miss the recovery. And I think it's really important. And it's one of the reasons why a diversified portfolio is going to be so much more important in the years ahead, even than it's been in the last few years. Let me show you what I mean as I go from bears to sharks. There is a shark attack going on right now in portfolios, and people are unaware of it. Let me explain what I mean. So looking back over the last 50 years or so, this is a chart of the relationship between international and U.S. stocks. The blue line, for example, goes up when U.S. stocks are outperforming, when international stocks are outperforming U.S. stocks, as they did in the 1980s. You see that big rise in the blue line in the 80s, all about Japan outperforming there. International stocks crushed U.S. stocks in the 80s. And the orange line, when that's going up, is when U.S. stocks are outperforming. They're literally, the lines are just mirror images of each other. But I do it this way to show you that the jaws are really extended right now and may be about to bite down, just like they did at the end of the 1980s as we entered into the 90s, and U.S. stocks led by technology really began to rally back. But if you look back carefully, every cycle we see different leadership, right? So the 80s was about international. The 90s, we saw that orange line go up as U.S. stocks outperformed. Then the 2000s, we saw the blue line go up, not to the extent we did in the 80s, but international stocks outperformed in the 2000s. And in the 2010s, incredible outperformance by U.S. stocks. So every single new cycle, we see this reverse. But you see that blue line? Oh, and by the way, these shaded columns, once again, they're recessions. I just shaded them blue this time instead of gray because the shark's gray. I just wanted to show them a little bit more clearly. But if you look at that recession in 2020, the pandemic recession, I thought we'd start to see the jaws begin to close. But we didn't. We did briefly, but then they widened right back out again. Why? It was only 2 months long. And it was followed by such a flood of liquidity, with the government just sending checks to everybody and the Fed printing so much money, that all the liquidity that had driven tech stocks, well, continued to drive them, right? And just continued to lift them right through that recession and right through the recovery beyond. Now we're in a very different environment. The Fed is draining liquidity from the markets. They're literally pulling cash back out again as they raise interest rates and begin to trim their balance sheet. And that is having the reverse effect. It's hard to see in this chart, but the jaws have started to close. In fact, if it wasn't for the 12% rise in the dollar this year, we'd be seeing international stocks outperforming by 14 percentage points this year. As it stands, as of right now, international stocks have outperformed by 2% this year, but the dollar has really masked a lot of that. We think the dollar's peaking and actually going to be headed down next year, and will begin to reveal this incredible underlying outperformance by international stocks that started this year as we started to see the recession unfold. Again, every time we see one of these blue columns, here they're blue, they were gray on the other charts, we see a reversal. I think we're getting a reversal right now. And we're starting to see that international outperformance begin to take shape. Again, it's only 2% so far this year, but it would be 14% if it wasn't for that dollar strength, which I think is going to be unwinding over the course of the next year or so. Let me show you another shark chart that illustrates this, but it's in the same currency, so you don't see how it's being masked by the dollar. This is the difference between growth and value stocks. Again, the jaws are starting to close here. You can start to see how those lines are beginning to shift. We've seen a rotation already out of growth and tech into value in areas like financials and energy, classic value stocks being less expensive, slower earnings growers, whereas tech, more expensive, faster earnings growth. We're already seeing that reversal, which happens every single cycle. So already we're seeing different leadership in the markets. And getting back to my point, why I moved from bears to sharks, was that everyone's focused on the bear right now and saying, well, when is the bear going to end? So all my US-led tech stocks can rebound again. Here's the thing, they may not. We might see different leadership in the markets. We're already seeing different leadership in the markets. I think these jaws have a lot further to go, where we get leadership out of areas that have lagged for a decade, that haven't outperformed since the 2000s, since 2008 or 2009. We're starting to see a rotation back into value, a rotation back in high dividend payers and lower valuation stocks, to international stocks, which both pay higher dividends and have lower valuations, areas that haven't performed in a long time. And so those investors that haven't rebalanced their portfolio, that maybe are acting on their own instincts and just chasing what had been the outperformers of the last 10 or 12 years, expecting them to be the first to bounce back, going to be disappointed, I think, as we get a rotation into new leadership, which is already happening. So again, I would set aside this question of when does the market bottom? No one ever knows for sure. We just know for sure it will. and looking out ahead, it's new leadership in the market. So thinking about a diversified portfolio, gosh, all you needed to own was like 4 stocks for the last 10 years and you would have done great. Very different now, right? A rotation to very different areas of the market. So that broader diversification beginning to pay off this year. I think we'll continue to do so in the years ahead. I know I hit that really hard and said it over and over and over again. I think it's the most important thing to focus on right now. New leadership in the market, not waiting for old leadership to rebound. So now let me talk about the bigger picture. Okay, when does the overall market get better? I got the rotation idea, Jeff. When does the overall picture get better? So much is dependent upon inflation, I'm sure, as you know. So what are we seeing on inflation? What should we be watching on inflation? Here's how inflation works. See, all prices don't peak at the same time. Usually, energy like oil, gas prices, along with other commodities like wheat or other grains, or metals, right? Copper, aluminum, they tend to peak first. And they already have. They actually peaked back in June. Oil peaked in June. So did copper, so did wheat, which was a big export from Ukraine. Those prices have come down sharply. They're now, in most cases, below where they were before Russia invaded Ukraine, including with wheat. But that's only 8% of inflation. So usually 2 to 4 months after that, we start to see goods prices peak out. Things like sneakers and sweaters and furniture and cars. Well, guess what? They did. They peaked out a few months after. They peaked out later in the summer. And we started to see in each of the reports we've gotten over the last 3 months, those prices have come down. But that's only 35% of inflation. The big nut, the big chunk of inflation is actually services. And most of that is housing. Housing makes up 40% of inflation. Sure, it's education. Yes, it's healthcare, and those things are certainly not going down in price. But man, it is housing that is the most important element of inflation for us to focus on right now. I just give you this chart here of German inflation. I could show you the same thing for the US or anywhere else, but we just got Germany's data this morning. So taking a look at this, what we can see is what's driving up Germany's inflation to being 10%, which is huge. You can see German inflation is usually 1 or 2%. Why is it so high? Look at the orange in this chart. That's housing. It's like half of inflation. The red, by the way, is food. So food is definitely contributing as well. But most of those food prices are I think beginning to level off, maybe begin to come down with the agricultural prices. But look at this. It's housing that's so high. So wait a second. Housing's not doing very well right now, right? Mortgage rates are up everywhere in the world. Housing affordability is worsening fast. Home sales activity is plunging. In fact, take a look at this. No matter where you look around the world, home sales are falling. This is the amount home sales activity, meaning the number of houses sold in each of these countries, has fallen since the post-pandemic peak, wherever it happened in late 2020 or 2021. In the US, it's down over 30%. In Canada, it's down over 60%. I mean, there are huge declines here in these markets around the world. So wait, why is housing inflation so high if we know prices are starting to come down, right? We've seen that anecdotally around the US, 1 or 2% declines in different markets, 4 or 5% declines maybe in Europe. Why is housing inflation still so high? Because we don't measure it that way. This very complicated chart is important for understanding all you need to know about inflation. The black dot is the percent of overall inflation that comes from the shelter component of inflation. So I mentioned housing in the US is about 40%. That's true, but it includes housing insurance, housing maintenance. About 33% of that housing component of overall inflation is just your house, is literally the structure itself. And so where does that come from? Well, the dark blue at the bottom, which you see in the US and many of the countries in the left, in the middle, and over on the right, well, that's rental rates. That's apartment rental rates. And if you see over on the right, those are all the European countries. That's the only way they measure housing inflation, is rental rates. Now, those are up. Why are they up? Because when housing affordability to buy a house has become really difficult, what do people do? Well, they rent. So as the Fed and other central banks have pushed up rates, making housing more difficult to afford, well, rental rates have been pushed up as a result. So they're actually worsening inflation right now, doing what they're doing with raising rates and making mortgages more costly. So that's pushing up inflation. But there's more to it in the US. Those orange lines are what we call owner's equivalent rent. Let me explain how that works. So there's a phone call that takes place by the Bureau of Labor Statistics to households around the US that have landlines. I don't know who those people are. I haven't had a landline in a decade, but they call them up and they say, hey, I know you own your house. We have that record. But if you were going to rent it out, I know you live there. You're not going to rent it out. But if you were, what do you think it would rent for? That's how they come up with inflation for housing in the US, which accounts for 1/3 of overall inflation. And it's what's so high right now. That's literally how they do it. And they ask those people that same question every 6 months. It's a different group every month. And they ask that same group every 6 months. So it takes a long time for it to roll over and begin to come down, because you're not even asking that same household that question again for another 6 months. A little crazy. That's how we do it. Don't expect that to plunge anytime soon. It takes a while for it to roll over. Apartment rental rates have started to peak out. They've started to come down a little bit, but not owner's equivalent rent. That'll probably continue to remain very stubborn over the next 6 months or so. And why we don't expect inflation in the US to come down till very late next year, maybe 3 or 4% by the end of the year, but it's going to be a while till we get there. Now, let me quickly address those 4 countries in the middle with the light blue line. Those are countries that use home prices. There are only 4 countries in the entire world that use home prices along with apartment rental rates to determine housing inflation. And that's New Zealand, Australia, Canada, and Sweden, all of which are seeing inflation plunge right now because those are coming down. And so their central banks have started to slow their pace of rate hikes or even announce that they might be pausing them very soon. It's a very different scenario. So I know I spent a lot of time on this, but really important understanding where we are in inflation right now. Watch housing, watch apartment rental rates, and then this imputed owner's equivalent rent. Takes a long time for that to roll over. The Fed knows about this, and they understand it's a weakness in the process, but they're having a hard time beginning to pull back from their rate hikes, knowing that this is remaining stubbornly high. So what are they doing? What are the prospects for rate hikes, given how important that's been for driving the overall market this year? I think they're peaking. So this is a chart. The line you can see is the number of the central banks around the world. So we have the Fed in the US. The Fed in Europe is called the European Central Bank. The Fed in Japan is the Bank of Japan. The Fed in Canada is the Bank of Canada, right? So we've got all these different central banks around the world. There are 115 of them that I track. And that's what you're seeing on this. The line is the number of those hiking rates minus those that are cutting rates. Believe it or not, there are some banks cutting rates, and that's what you see there in orange, and the blue is just the ones hiking, and the line is the net of the two. Uzbekistan is cutting rates. Russia is cutting rates. China has been recently cutting rates. There are a few out there, but we're seeing obviously most are hiking rates, in fact, the most ever. But look at the line, it's starting to peak out. We're starting to see, increasingly more of them are stopping and pausing. And let me show you another complicated chart of what I think this looks like right now. I know this is very busy, but bear with me because it's a very good story. And that is, we're seeing some of the world's biggest central banks slow down the pace of their rate hikes and maybe pausing them. So I'll start up top. Each one of the blocks is 25 basis points, a quarter of a percentage point, right? And how much of the central bank is hiking. Any column that doesn't have any boxes in it is just a month where the central bank didn't meet. So if you look back to earlier this year, Brazil's got 6 boxes. That was 150 basis points, right? 6 25 basis points added together. They raised rates by 150 basis points in one meeting. Then they dropped to 100. And they skipped a month, and the next meeting, 100. And then down to 50, and then 50 again. And then they stopped. And, if you look at the next one down, Poland, Brazil is one of the biggest emerging market central banks. Poland is one of the biggest emerging market central banks in Europe. They increased their hikes, and then they faded them and stopped them in October. And then we see Norway went from 250 basis point rate hikes to 25. They're expected to stop and not hike in December. That's what that gray shaded column is. Australia went from 50 to 25. They might not hike at all in December. Canada, they went from 100 basis points to 75 to 50. Now the expectation is maybe 25, maybe 50 in December. We'll have to see. European Central Bank, that's ECB, they're going from 50 to 25 is the expectation. And the same thing in the US, going from 50 or 75 in November to 50 here. And I should have said the same thing for the ECB, 75 to 50. The point of this is that we're seeing a slowdown. The market's been waiting for this. That's why we've seen this rally in October and November, signs that they're starting to pull back, that the worst is maybe over. They've got a few more rate hikes left, but they're smaller and maybe more spaced out, and we're getting close to the end of the line. This is very important. Continuing this stepping down of rate hikes, critical to keeping the market on a recovery path. If there's some evidence that inflation's picking back up again or developments that could cause that, we might see this picture change, and that could really reverse the market rally that we've seen. In fact, the best rally we've seen around the world are the countries that have already stopped hiking rates. Brazil, stocks in Brazil are up 25% this year, up 25% this year. Poland stocks are outperforming the S&P 500. In Norway, in Canada, in Europe, they're all outperforming the US, which is still hiking rates, right? So interesting to see how important this is to the overall market. Again, tied back to inflation, and as that's beginning to come down, very important to the central bank picture. So quickly, where are we going on all this? Well, This is what the market thinks lies ahead for rate hikes. So you've got the Fed here, rates that are being set by the Fed in blue, by the UK in green, and European Central Bank in orange. And I'm just showing not so much the difference between them, there's always a difference between them, but what's the trajectory? And if you take a look here, the shaded area is looking forward. And I'm just using what the market is expecting. The market's already priced in terms of where they think the central banks are going to go. They think the Fed's going to go to 5%. Probably somewhere at the end of the first quarter, they're going to get there. Same thing for the European Central Bank. Maybe they get to 3, somewhere maybe around the end of the first quarter, middle of the second quarter. And then they think they're going to stop and just hold rates flat. And I just extended this through basically the end of next year, but I could extend this out through 2025. The market thinks central banks are going to hike rates a few more times and stop for years, just hold them flat. And it's possible, but it's never happened before. I think this scenario might be a little different. Let me show you the history of these rates. They go up, they come down. They go up, they come down. So you can see on the far right, that's the projection that I just showed you. I zoomed in. This is looking back over the last 50 years. Look at the 1970s. We know that was a period where inflation was just high for a long period of time. Well, the Fed raised rates, and then cut rates, and then raise rates, and then cut rates. So other central banks did as well. I think it's very unlikely they hike and hold. I think it's more likely that they hike early next year, maybe by the end of the year. The market's already expecting that they might begin to cut interest rates. I think that might become part of the market's thinking. The market might get excited about this, but there's a risk to that idea. And the risk comes from China. China's still locked down. China hasn't really reopened from COVID. For a lot of self-inflicted issues, China remains firmly locked down, implementing their zero COVID protocols. There's been some movement back and forth on this lately. They refined some of the rules, but they're still very locked down. Here's the thing. China's clearly sending signals that they're planning on reopening maybe March, April of next year, once they get better vaccination. And by the way, they've now approved Pfizer and BioNTech's vaccine for use in China. The Paxlovid antiviral pills now approved for use in China. So they're ramping up manufacturing of those things, beginning to roll them out. They're building more ICU beds. They're getting prepared for March and April, where they've actually scheduled some global events to begin to take place. The Formula One Grand Prix is in Shanghai, scheduled for April. The government just approved that. So I think they're planning on a reopening. Here's the thing. Chinese retail sales have been very weak. I'm just showing you here October and taking a look at what it is versus history. Chinese haven't been spending money. They've been producing. They've been quarantining at work, making things, haven't been able to get out and do any shopping. When they do, they have 3 years of pent-up demand. Income, because they've been working, no way to spend it. So I think it could really unleash a lot of demand. There's 1.4 billion consumers with middle-class incomes pretty similar to Europe and the US. So you could really see that hit in a big way, pushing up commodities and goods prices in the second quarter of next year, just when we thought the central banks would begin to feel that they could stop hiking rates because inflation was coming down. What if inflation gets exported from China to the rest of the world? And we start to see a resurgence. And remember, I said furniture and cars and apparel prices were coming down. Everything was coming down except for housing. Well, housing might begin to show signs of coming down in the second quarter of next year, just as prices for everything else reverse course and start to come back up. It's not my base case at the moment, but I'm worried about it. And I'm worried it could change the prospects for what the Fed and other central banks might do. Right now, hike and then hold steady. What if they have to hike more or cut and then have to reverse that very sharply? I think there's a potential for some volatility next year. I still see leadership in international value-oriented stocks. I think they're going to be better able to weather that potential volatility. A brighter year next year, I think, overall for stocks and bonds, but one that could incorporate some volatility here if China reopens in an abrupt way in the second quarter. Again, hard to know. I don't know what Xi Jinping's head around that reopening, exact timing of it. So let me conclude with some ideas and get to your questions. I'm a couple minutes over. Number one is focusing on value stocks. Remember I talked about value versus growth? Let me explain. One of the ways I like to define that is Low price to cash flow stocks. We often talk about price to earnings. I like low price to cash flow. I call them short duration stocks. The way we'd favor short duration bonds when interest rates are rising, short duration stocks, those with high cash flow relative to their price, have done really well. In fact, if we look back to August of 2020, when interest rates began to rise, that orange column, which is the lowest price to cash flow stocks, the bottom 20% of the market defined by price to cash flow, are up a huge amount. Whereas the overall market's up, 20% or so, more than doubled that. And the most expensive stocks on price to cash flow are actually down. And look at this year. The overall market, when I ran this, down double digits, not the lowest price to cash flow stocks. They're only down about 5% or so, and the most expensive stocks down pretty dramatically. And you can see that was also the case so far this quarter, which is really important because not only have these stocks outperformed as the market went down, they've outperformed in October and November as the market has rallied back. Again, this is my point around new leadership in the market, not just on the downside, but on the upside as well, right? So we don't have to time when the market's going to bottom. No one knows the day, the hour, the week when the market's going to bottom, but you can find those stocks that are most likely to lead when it does, because they're also the ones that are protecting capital the most on the way down. So again, broad diversification, not just in those high-tech growth stocks that have gotten us here over the last 10 years, but thinking about other types of stocks in a diversified portfolio that are paying off right now. And then finally, here's another idea. Very hard to read this chart. I know it's small, but I wanted to really demonstrate it in a complete way. High dividend paying stocks. No one's cared about dividends for decades when stocks were, for a decade when stocks were going up 10, 15, 20% a year. Now they're the rage, and I think they're going to continue to be. High dividend payers have outperformed in almost every recessionary bear market, and that's what I'm showing you here. These are time periods when we were in a recessionary bear market going back over the last 50 years. The charts up top show what the high dividend stock market did, the high dividend payers did versus the overall market. The difference between the two is the orange columns below. You can see outperformance by high dividend payers in every single period except 2008, when the high dividend payers were financial stocks, the big banks. Was the financial crisis. They didn't do well. Now we're seeing double-digit outperformance by high dividend payers on the downside, and in the recovery on the upside as well, we're seeing these stocks lead. So again, different leadership in portfolios, again, focusing on the benefits of a broadly diversified across styles, sectors, and geography. I think very important to investment success right now. So let me finish up saying consider international. I know it's been a long time since it's outperformed, but I think you do want to have some of that in your broadly diversified portfolio. Short duration, high dividends. Again, another way of thinking about incorporating different stocks than just those tech high flyers that we fell in love with for the last decade. And then housing is the key. Apartment rental rates in particular, and that owner's equivalent rent, watching that very closely for a peak in inflation. And as that begins to come down, the Fed can begin to let its foot off the gas, or the brake, I should say, but keeping also a focus on China and when they reopen next year and the potential inflationary consequences of that as a shock, perhaps much as Russia's invasion of Ukraine was to 2022. So Joe, those are my thoughts. I'll stop there and just see what questions or comments or thoughts have come in as I was talking.
Yeah, thanks, Jeff. That was great. A lot of really good nuggets there. We've got a lot of really good questions, so maybe I'll just jump right in. Let's stay on the China theme for a moment. You talked about the impact of their reopening, what that could be. A couple of thoughts there. One, is China itself investable? Can we trust what's coming out of there? And is that an area of the market that we should be considering?
China, a little over 10 years ago, maybe 15 years ago, stock market was dominated by government-owned businesses. And you don't want to be a partner with the Chinese government in owning a business. It's just not in your favor. That is completely untrue now. 95% of the stocks in the MSCI China Index are privately owned. They are entrepreneurs. And, when I go to China, I always meet with the American Chamber of Commerce in Beijing or in other major cities. And it's amazing the amount of innovation and capitalism that's going on at the entrepreneurial level in China. I'm excited about it. There are some world-class companies that have emerged out of China that are not in any way owned by the government. They are subject to government oversight, of course, and audits, but they are completely independent and in many cases have listed on the New York Stock Exchange and aren't listed in China because they don't want that governmental oversight. And now, fortunately, we've had a breakthrough in the accounting issues that were a little bit of a rub for a while. Those are no longer issues. Remember, big companies like Alibaba, as an example, are audited by the same global auditors that Amazon is audited by. Same reports are filed, same auditor, same firm, and now U.S. overseers, regulatory overseers of auditors can now access all that data as well. So none of those issues anymore. So I want to have people recognize that we're talking about entrepreneurial capital businesses in China. That said, China, if you're a business in China, a lot of your business is in China, right? It's focused on Chinese consumers. And if they can't get out and spend, it's a tough time. But that said, it's a tough time for other businesses as well. GM, General Motors, gets 50% of its sales in China. Tesla gets 1/3 of its sales in China. Micron Technology, big US, memory chip maker, 47% of its revenues in China. Starbucks gets a huge share of revenue in China. Intel, 25% of its revenue from China, right? So you're getting Chinese revenue exposure, and you're seeing that Chinese consumer slow down. You're feeling it in a lot of those stocks. So it's not like, well, if I avoid China, I'm not going to get that. No, you're getting it because Chinese businesses sell to the Chinese just as they sell around the world. I think they're investable. I do think China's struggling right now, hopefully coming out of that as we look at next year and reopening to the global economy. As we think about politics, let me just say, I know there's been a lot of stress about China and Taiwan, concerns about a conflict there, mirroring what we're seeing with Russia and Ukraine. Two completely separate issues. China's been very transparent about the red lines for Taiwan that would result in military action by China towards Taiwan. There are 4 of them. Very briefly, if Taiwan were to gain the same standing in international organizations that China has, for example, if Taiwan were a member of NATO or a member of the UN, none of these things are on a list of going to happen. And Taiwan is not going to get peer status to China in multinational organizations. It's just not happening. It's not on anyone's agenda. Number 2 would be if all of the political parties in Taiwan cut off any potential talks about reunification with China. Well, there's one party, which is the Chinese Nationalist Party, which exists really only to remerge. So they would never cut off those talks. And in fact, a member of that party just became mayor of Taipei, the capital of Taiwan. So there's no sign of tension there. The most important, I know there's 4, I won't get into all of them. The most important one is if the leaders of Taiwan would declare independence from China. Highly unlikely. There's a survey done every 6 months of the Taiwanese population done by the National Chengchi University in Taiwan. This goes back 30 years. So we've got a good read on sentiment towards reunification versus independence. And overwhelmingly, the people are voting for the status quo, which is, yeah, we're part of China, but we're really independently governed and operated. And that's fine with 57% of the population. There's only 5% of the population that favors immediately declaring independence from China. Nowhere near the critical mass it would take for Taiwan's democratically elected leadership to step back and say, no, we're going to declare independence from Taiwan and invite some kind of military conflict. There are and there's an equal percentage who want to immediately reunify with China. So no, this is just not likely to happen anytime in the next 12, 24 months, certainly as we look at this survey. And while China does send its airplanes and fighters and bombers into Taiwanese airspace as a regular part of their harassment and reminding Taiwan they're technically still part of China, I don't see the likelihood of any type of military engagement there in 2023. So I don't think that's a very similar situation. And I don't think that puts China off limits as an investable destination. I just note Chinese stocks are up 25% this month on prospects for reopening, and emerging market stocks have really felt the benefit of that. China makes a big share of the emerging market index. So, recognizing that we probably all have a little bit of emerging markets in our portfolio, it makes sense to have a little bit of emerging markets given the volatility of that asset class and its potential as we look out to 2023 reopening of China.
Yeah, thanks. That's a great lead into my next question. I wanted to talk a little bit about, you mentioned during your comments, you anticipated the dollar to start to weaken. So a couple points of that. One, what do you see as the catalyst there? And then a lot of people think about that in terms of emerging markets, like you just mentioned. And if there's an asset class that's sort of been left for dead, I think that may be the one. And I think what we're hearing you say is maybe not so fast, but could you comment a little bit about the dollar and maybe emerging markets if you have any more things to say there?
Right, Joe. I'm sure, as you know, when the dollar starts to go down, emerging markets are the best performing asset class. They just do so well because historically, they've been vulnerable to a rise in the dollar. When the dollar goes up, their currencies tend to plunge because in many cases, historically, they borrowed a lot in dollar terms, meaning, they would issue bonds, but they were denominated in dollars. So when the dollar goes up, their interest payments go up. The cost of those bonds go up. That isn't so true anymore. They've really issued the vast bulk of their debt in their own local currency. So they've been relatively unaffected by the rise in the dollar. Although interestingly, many of them export commodities priced in dollars, like oil. They've actually benefited this time from the rise in the dollar. If we look at some countries that are chronically been vulnerable to a rise in the dollar, like India's rupee or China's yuan, they've actually done better than the euro and the yen and the pound this year. So they've actually done really well. So it's been a bit different. So rather than, as soon as the dollar starts to come down, we'll see emerging markets just do incredibly well. Well, maybe not as well as in the past because they didn't suffer as much this time. They've actually pretty much performed in line with the S&P 500 this year, maybe under by 1% or 2%, given the drag from China, but that's starting to change. And by the end of the year, probably be in line. So as we start to see the dollar come down, why? Several different things. One, what tends to drive currencies, at least in the near term, is the difference in interest rates. Well, the Fed hiked interest rates more than other countries. Remember, I had that chart, Fed's going to 5%, Europe's only going to 3%. Well, as they're hiking faster than other countries, well, you're making more on your cash in dollars than you are in euros. So, the world deposits its cash in dollars and buys more dollars to do it. That is likely to end early next year. And already the market's sniffing that out. And that's why the dollars begin to already level off and begin to come down for its peak in late September, recognizing that the widening differential in rate hikes is probably near its end. And then we face the challenge of the U.S. having a massive and arguably unsustainable budget deficit. And trying to finance that means we have to make our debt more attractive. And the way we can do that is find some weakness in the currency. In fact, that's often what happens when countries expand their budgets at the pace that we have. They're forced to see their currencies decline to make that debt more attractive. In euros or in yen or in other places around the world that buy our debt, they're actually getting more of an interest payment because those dollars are translating into more and more euros or more yen as they get those interest payments. So it's sort of interesting how that works out. But I think a lot of the challenges we're facing next year, the end of rate hikes, and then correspondingly with that, the financing of the budget deficit, the fact that we have a massive trade deficit as well, which continues to grow, also puts a burden on currency. So we're seeing a reversion back to some of the things that put downward pressure on the dollar in prior cycles, beginning to rear their heads again. We don't see a bear market, a crash in the dollar by any means. There's still healthy demand for dollar assets, but maybe a bit of a slide next year after what's been an incredible run up this year. Rarely do we see a year with a double-digit rise in the value of the dollar, and we're likely to see some of that give back here over the next 12 months.
Thank you. Jeff, I think there's a fair number of people on the call who, over the entire course of their investing career or however long they've been in the markets, bonds have been a safe place to earn a fair yield. And a lot of that's been with interest rates really being driven down over the last 40 years. Well, obviously that's changed. And a 10 or 15% move in stocks is not very uncommon within a year, but that's a once in a generational thing within the bond market. And maybe speak a little bit to one, do we see a new, an opportunity from an entry point standpoint back into bonds? How are you thinking about that? And for those people who have sort of counted on that as a kind of the steady Eddie part of their portfolio, how should they think about that going forward?
Yeah, boy, it's been a tough year, and the abrupt move in interest rates is just been unprecedented. Not just in the U.S. We saw huge move in the UK, huge move in Europe. Even Japan has struggled to keep its rates from rising. They try and keep their rates in a very narrow band, and it's been at the top of that band, and they're forced to spend a whole lot of money to try and maintain that. So it's been a global phenomenon. Fortunately, we've kind of recharged the value of bonds. There's now income in fixed income again. And, when we see declines in the bond market, it's usually because interest rates were very, very, very low, and you didn't get any kind of income cushion to offset the negative price effect of a rise in interest rates. Well, now we've got some income back in there. We've got that rise in rates and recharge the value of fixed income as an asset class. We find, a more intermediate duration attractive. I think people have been moving to the shorter end of the yield curve for a while here as rates have gone up. We think you can extend again. And we think we've probably seen the peak in interest rates for this cycle. Usually rates peak somewhere around where the Fed's headed. We saw a peak a month or two ago, began to come back a little bit from there. Not necessarily saying we're going to see sharp declines, but certainly the worst of the bond bear market is well over at this point. We have a much brighter outlook for bonds as we look out to next year, at least collecting the income, the income component of that, maybe even seeing a little bit of price appreciation if yields pull back just a little bit. Corporate bonds look attractive to us. Maybe not yet high yield. There's some argument for some high yield, perhaps exposure in a portfolio, but still finding that maybe with earnings revisions still on the downside, as much as there might be some potential for volatility in the next few months in the stock market, as earnings revisions come down and we feel our way through the bottom of this recession, high yield bonds may feel that volatility as well. But I think as we move deeper into next year, there'll be an opportunity also in the high yield marketplace. So bonds are looking more attractive than they have in quite some time. Unfortunately, that came with a bit of pain this year.
Yeah, certainly. Okay, just a couple more and we'll wrap up. And I apologize if you've already commented on this, but maybe just speak briefly about the energy market, and do we see that bull market continuing?
Yeah, real quick. So, energy, the energy sector as an investment so much tracks oil prices. Whether it should or shouldn't is debatable. They really make their money on a spread over crude oil with the distillates that they sell. But the reality is they move with the price of these products. So where is oil headed? Is it going to stabilize, which is fine for these businesses, or is it going to rise, or is it going to fall? And so much is going to be dependent upon the reopening of China. China is the world's biggest importer of oil, of energy. And if China reopens, the amount of air traffic in China and all around Asia is extremely depressed, and it's very fuel sensitive. So, if we start to see that reopening come in a bigger way, Japan has started to reopen, tourism is starting to pick back up. We've seen it in a number of other countries. If China reopens more significantly, and they've already reduced quarantine times for travelers and where you can quarantine home now instead of a quarantine hotel. All that could mean huge demand for travel for a population that hasn't traveled in 3 years. Huge explosion on the upside for demand. At the same time, supply has been tightened up by OPEC, and just the fact that Europe refuses to buy Russian crude. So all the U.S. excess oil we've got has been shipping to Europe, and a lot of the Russian stuff has gone to China and India. But there would be a real demand picture. That would be an upside surprise. Depending how quickly they reopen, could be a real upside shock to oil prices. That said, if they remain locked down longer because they can't get their arms around this, there is already an oversupply situation at the moment, which means oil prices could continue to drift lower. So there's this sort of bifurcated outcome. I think oil prices probably remain in a range near where they are now. That's still very profitable for energy companies. And many of these energy companies have a lot of green projects that are going to get the benefit of funding from governments. Europe is implementing their new Green Deal. This is a trillion I just pulled a Dr. Evil there. A trillion in new spending on new green technology initiatives. Many of the energy companies in Europe, BP, Shell, just to mention two in the UK, but there are many others in Europe that are on top of this. They're going to benefit from this trend. And so when you think about energy, it formerly was just oil prices, but now there's more to drive their revenue, and they're on top of a lot of that. So anyway, I see that energy as part of the value universe of stocks still may have some legs next year, even after an incredible outperformance this year.
Thanks, Jeff. No, we sincerely appreciate your comments today. I think that was certainly enlightening for me. I hope it was for all of you. With markets come opportunity, right? We've seen some unprecedented things happen in 2022, but with that comes some unique opportunities, particularly from a financial planning perspective. Boulay Financial Advisors sees investments in markets as one of the very key components of your overall financial plan. Our financial planning process that we refer to as Wealth Nav is really designed to incorporate your goals, your investments, your stage of life, and how we bring that all together. We work with families and professionals and institutions bringing creative financial solutions to life. So if you'd be open to a conversation, we'd encourage you to reach out. Jeff, I'll have you go to the last slide, and I'll mention a couple final comments. One is we've moved. We've got a new address. If you're familiar with our office in Eden Prairie, we moved about a block south onto Viking Drive, right up next to 494. So we'd love to see you in person. Certainly come see us at any point in time. And then lastly, we have another webinar in the future. We plan to do an investment related webinar on January 25th into the new year. So mark your calendars for that. More details to come. And we look forward to your participation then. On behalf of all of us, thank you, Jeff. Thanks to all of our audience. Thanks for the great questions, and we appreciate your time and attention. Have a great day.